All right. Hello, everyone. Welcome to our November Investors Performance Group meeting. I am looking forward to bringing this one to you guys because we are in our final IPG of 2025, if you can believe that already. We have quite the night for you guys today as we kind of look back on 2025. It's been an interesting year to say the least. So we're going to be taking a look back, not just on the numbers in the market like we normally do. We're going to do a little bit of a side by side comparison as we look at the numbers to really understand the changes that have actually happened. Then we're going to be bringing up Tim Lyon, who's going to be talking to us all about the mortgage side of things. We've got some hot deals. So we're going to jump right into things. Of course, as you guys are joining the live stream here, I would love to know where you guys are tuning in from tonight. So drop it over in the chat. Let me know who we have here tonight. And of course, I would love for you guys to be interactive with this. So if you guys have any questions at all, make sure you guys throw it in the chat and let's try to make this as interactive as we possibly can. Seeing as we're not live in person for these right now, we still want to be as interactive as possible. So again, drop where you guys are coming from and let's get rocking and rolling. All right, here we go. Investors Performance Group meeting, November 2025. So for those guys who may not have been to an Investors Performance Group meeting or watched it live yet, the Investors Performance Group is brought to you by the Kelly Fry team. We are a full-service real estate investment team to help you guys grow your portfolio in and around the Greater Vancouver and the Fraser Valley area. And of course, we partner with some of the best in the industry to help provide you a powerful our team. That includes great mortgage brokers, home inspectors, accountants, lawyers, anyone you need to be successful in helping you grow your portfolio and your business. Now, as you may have noticed, as you jumped on the live stream, things are looking a little different again. For those of you guys who know me, every November I participate in Movember. This is due to the fact that I did have some family members affected by cancer that we are unfortunately no longer with us today. So I made a pledge that every single November, I'm going to grow out the stash and as well as raise money for a great cause for cancer research and, of course, for men's mental health. So we have a goal to reach $3,000 raised this month. We're working on that right now, as well as we got a team goal to do 10,000. So if you guys would like to support me in my goals here, feel free to scan that QR code with your phone and go ahead and donate. Everything helps. Everything adds up. So donate whatever you can and help me change the face of men's health out there. All right, now as we go on, as we said, we're going to do a market deep dive. We're going to look back on what has happened in 2025, what the effects have been on the market, and then we're going to talk a little bit openly. We'll have a discussion, and I'm sure Tim will join us on that discussion as well on what we expect 2026 to bring about. Then, of course, we're going to bring Tim up to talk about the mortgage review and what his predictions are on the mortgage side of things. Then we're going to wrap up with some hot deals for you. All right. Don't forget as well, feel free to take screenshots. I know we're not live in person. You can't take photos necessarily of us speaking, but take some screenshots. And if you have any really good ahas, feel free to share it because if you're an investor out there and you're looking to do more deals, you definitely want to also think about raising capital. The more that you show your expertise by surrounding yourself with great people, the more you can help raise your capital, and sharing your ahas with others will help them as well. All right, so let's talk about it. The market. Now, this is a segment we do every single month where we talk about what's going on in the market and what it's like affecting investors out there. We try to look at it from that investor lens. We try to look behind what has actually been talked about with the media, see how it's actually affecting you, and maybe seeing where those opportunities might lie. So, what we like to do is we'll bring up kind of what the Greater Vancouver and Fraser Valley real estate boards are saying. Now, GVR says that slower sales and building inventory creates favorable conditions for those looking to buy in the fall market. As investors, traditionally, are we buyers or sellers? Maybe if things are looking favorable, we got to keep that in mind. And then Fraser Valley Real Estate Board says home sales climbed for the second straight month in October, a sign that some buyers may be responding to steadily easing prices. Makes you think, right? If other buyers are starting to take notice and we're starting to see a little bit more activity, we don't want to be left behind necessarily. Now, I'm not saying to go and rush into a deal right away. This is not 2020, 2021. We're not in a seller's market, but start creatively thinking what you might be able to do. Welcome, everyone. I've been seeing you guys in the chat. I appreciate it. Thank you for the compliment on this mustache. I appreciate it. Again, feel free to throw lots of comments in the chat. We'd love to hear from you guys and where you guys are tuning in from as well. All right, so let's kick it off. We're going to take a look at what's happened in the inventory. Now, as you can see, and I'd like to really point this out, and I think you can see my cursor, through 2025, we kind of sit here around like December, January. We saw a steady incline through the spring market, right? That took us from about December all the way to about May 2025, where we saw sharp increases both in Greater Vancouver and the Fraser Valley. Now, Chilliwack being a smaller region, it saw growth, but it was pretty steady overall. However, from there, we haven't seen too much of the traditional drop that we have during summer. And, sometimes it spikes back up a little bit in the fall. We've kind of been maintaining that high level of inventory overall throughout the fall market, as well as in the Fraser Valley. We haven't seen that drop off yet. So that means that even if sales are happening, we're basically taking on as much listings, if not a little bit more, every single month to offset the sales that are happening, causing a lot more inventory and a lot more choice for buyers. Now, when we look at the actual sales, the good news is, exactly as the boards reported, we did see some growth in sales in October. This is the first time we've seen any sort of spike in sales, as you can see, through the fall. And it was a decent jump. I mean, we hit about 2,255 sales in Greater Vancouver, a little over 1,063 sales right there in the Fraser Valley. 177 is actually down still in Chilliwack comparative to last year. So overall, we saw a little bit of absorption of inventory compared to previous months. And we're kind of on par with, the summer market there where we capped out at the end of spring. So very interesting to watch. And again, this might be a sign that things may start to be changing a little bit. However, the key here is that we can't just take this 100% as gospel, though. As investors, we got to look at this critically and look at and say, well, that's 1 month of sales increase and inventory decreasing. We now need to be watching November and December. Now, here's what my expectation is for those 2 months. We're likely to see November's listings start to drop off as well as December. I mean, a lot of people will say, I'm going to take my home off the market. It's Christmas. We were unsuccessful. We're going to try again in the springtime. So as investors, that's important to know as well, that a majority of sellers believe that spring is a really good time to sell their home, that more buyers are coming. But when a lot of sellers all think the same thing, what does that cause? A spike in inventory. And possibly as we head into spring, to me, that screams possible deals if we don't have the sales uptick like we have. Now, let's take a look at what that relationship has been on prices. Now, throughout the year, we've been fairly steady as an average. Right now, we're looking at this thing from the fact that we've got Greater Vancouver, which encompasses many different areas, as well as the Fraser Valley, many different areas as well. So you can see it's been pretty steady. We actually have some slight growth in the Greater Vancouver area over last year, where it capped out in October. The prices have come up a little bit, as you can see right here, as well as the Fraser Valley saw a little uptick from October, whereas we've continued to see some decrease in the Chilliwack market. So we're looking at that from a long-term perspective. If we've been seeing a bit of a steady average here, we've got some ups, we've got some downs. That's going to happen depending on what sells. Does that mean we have now hit the bottom of the market, or could it go down further? I mean, it all depends, of course, but this is showing that things have been pretty steady across the board in values. Now, it's very important, and we always do this where we do a deeper dive onto the different markets and what is actually happening in those markets. So we'll definitely take a look there. But this is a good indicator that we haven't seen a huge amount of movement in certain pockets, certain areas as a whole. So maybe the article's out there saying the crash is still coming. Maybe, but maybe not. Oops. Let's go to the next slide here. All right. And we've been adding this slide in here for the last few months. And this is the sales to active ratio. So this helps us to understand what type of market are we in? Are we in a buyer's market? Are we in a seller's market? Or are we sitting in that balanced market territory? Now, traditionally, properties that are sitting between 12 and 20% is in a balanced market. And as you can see here, we have actually pushed into a balanced market on all three of the regions right now. Fraser Valley being the lowest, still just right on the cusp of that buyer's market. But as you can see, it was down deep into the buyer's market through fall, meaning more sales happening is pushing this thing back into that balanced category. So when you start to see more balanced markets and pushing up as high as you see 14%, you're going to see some sellers start to dig in their heels a little bit, and they're not going to be as negotiable as they once were. So that's because they're seeing more activity on their listings, and it gives them a lot of confidence and courage that maybe they'll still be able to get their price. So keep that in mind when you guys are putting offers in. Sometimes your stink bid offers may not go through, and it may offend someone, especially if they're days on market. Looking for those that are a little higher days on market. And then finally, the percent of original price. So this means what are people actually paying in relation to the final listing price? Now, that's where this, I will say, is a little skewed. This only talks about what the percentage is of the list price at the final price. Sorry, of original price, because they might have done some reductions. However, this doesn't factor in those people who are strategically canceling their listings and then reducing their price. That happens a lot in this industry. So keep this in mind that right now, the average sale right now is around that 96 to 97% across most of the regions where you're actually getting it. So if you're buying something, it's $1 million, you're getting it for around the 960 mark, give or take. Now, again, what this doesn't factor in is that cancel realist. It's only of that original listing price that people have set. So some areas you're seeing better deals and you're actually beating this. And if you do beat this, congratulations, you've done a great job on the market. Other areas are not beating this. And that's where looking at those micro trends to make the smart offers are going to come into play. All right. So now, we did talk about really doing a deep dive look back at 2025. So to do that, we're going to have to go back in time a little bit. So I've implemented and gotten my friend Marty McFly to help me out with that. So we're going to jump in and we're going to head out there. To the right speeds. So here we go. All right, everyone's ready to go back in time with me? Imagine actually going back to 1985 right now and the prices that they would be. That would be pretty incredible. Buy at that point. We all know what's happened now. All right, here we go. We got enough speed. There's the Doc. Doc Brown. Is he going to make it in time, or are we going to go back in time? Here we go. All right, so going back in time, we're going to start looking at what has actually happened in a bunch of these markets. Now, this is the traditional slide that you will normally see during IPG, but we've decided to add a little bit of something to each one of these that's going to show the real comparison to understand what these changes in prices actually mean. So we're going to look back at October 2024 numbers, especially we're going to focus on the prices right now. So when we say, well, Chilliwack right now is sitting at 900,000, it's down at 9.6%. What does that actually mean? So as you can see here, when we take a look at Chilliwack, back in October 2024, we were sitting at about 955, almost $956,000 as an average. So now over the last year, we have dropped 9.6% in total, meaning we're now sitting at that average of $900,000. So you can now see the impact of the change in the market over time and what that means from an equity perspective for the average seller in that area. Now, as you can see with Chilliwack townhouses, they're down 14%. So it's almost, not quite, but almost $100,000 difference between the 643,000 that people were paying back in 2024 to the 522,000 that they're paying now. And condos, a 15% difference as well, just over, it's about 57, just a little over, sorry, it's almost 50. My math is like totally off. It's actually like over 50,000 for sure. So anyways, you get the point. 405 to 343, down 15.2%. Now here's a couple more things we do want to look at. Obviously, days on market. Days on market, we're averaging 43. It has come down a little bit. Detached are selling a little quicker now, but townhouses are taking longer. It was 30 days on market back in 2024. It's up 43% to 43 days on market. And townhouses or condos are now almost 2 months to sell in Chilliwack. And you can see the difference in the inventory rise as well. So back in October 2024, we had 278 units on the market. We're now at 319. That's up 14%. 79 units for townhouses, up to 95 now, 20.3%. And of course, we haven't had a huge change in the condo market there, but they have definitely taken a hit. So as you can see now, the relationship in what we talk about when we say down 9.6, down 14.2%, the actual financial impact of that change. And I thought this was really important for us to go back and look at, because obviously October 2024 was leading us into 2025, and we can see that change that's happened in the market. Now, Abbotsford is actually showing pretty stable in the detached and the townhouse market. It is down in the condo market. When we go back in time, this is what the relationship changes. So actually, over last year, as an average, detached properties have gained about $10,000 in value, and the condos up about 6,000, give or take. Condos, though, have dropped. It looks like about 13,000 or so, down 2.8%. And you can see days on market, though, are up across the board. So it's taking longer to sell in the Abbotsford market. And of course, inventory is still on the rise in this market. So maybe by November, we will see these numbers start to change. Remember, these are October numbers as well. Okay, Mission down 1%, townhouses, or sorry, 0.1%, townhouses down 0.7%. Condos are actually up though. But again, you can see the inventory total of these two areas. They're not that high overall. There's not a ton of attached properties. But what does this mean in relationship to last year? Well, last year, I mean, not a huge change. We're pretty par. I mean, it's like less than $1,000 change there. Townhouses were sitting at about a $5,000 difference at this point. Sorry, my math is so off. Yeah, 5,000. And hello, Kelly. Thanks for joining. And then, of course, the condos have actually gone up in value. But you can see here, it's now taking, I mean, a lot. Look at those condos, 87 days to sell a condo right now in the Mission market. So your days on market have jumped up quite a bit. And that will start to have an impact in this market going forward. And we probably won't see too much growth in that condo market as well. Inventory is up slightly. It's down a little bit in the townhouse market. It is a little faster to sell townhouses right now. And it's almost, it's a month and a half right now to sell a average detached home. All right, taking a look at Langley again. Let's go back in time. And as you can see here, it's held pretty steady compared to last year. Last year, it was about 1,589,000. Now we're sitting down 1.5% at 1,574,000. Townhouses took a little bit of a bigger hit at 3.5% down over last year. And you can see the relationship on what that means value-wise. We're seeing almost $30,000 difference there at a 3.5% drop. And then again, condos took a bit of a hit, about $19,000 as well in equity loss in the condo market there. Now you can see here, days on market are up quite a bit, especially in the detached and the condo market. And the huge jump right now that we've seen is especially in the condo market here, 15.4% increase. I mean, this was a huge jump as well. But what we are finding is the condo market is very, very, very slow right now in Langley. Now, a couple things that we've also done showing you guys the relationship between different areas within a city. We've got Langley City here. Now, these are just the 2025 numbers, but if we look at the difference between certain areas, you now understand what's going on. If you take a look at Langley as an average and you look at what's happening in Langley City is definitely getting hit the hardest, because we can see the average was only down 1.5% as an average across the board in Langley, which Langley is a big area. But specifically, Langley City has dropped 14%. So that is a massive drop in that area. So sellers are definitely feeling the pinch in and around Langley City. You got days on market going up in that area. And of course, you've got inventory up 20, almost 30%. Townhouses have fared a little better. You know, it's down as an average in Langley, but it's actually up 3% in Langley City. And then the Langley condos are taking a bigger hit than the average as well. So again, we wanted to show you guys a little bit of those sub-markets as well to make sure that we understand there's no such thing as a Canadian real estate market, right? We are talking Langley, and within Langley, there's Langley City, there's Willowbrook, there's Willoughby Heights, like all those areas. So Okay, Maple Ridge is down across the board. Townhouses have taken the biggest hit, and you can see the impact on the townhouses over last year. Last year, they were selling at just under $800,000. Now we are sitting at 600 and just under $75,000 at this point. A big part of that is obviously days on market is going up, so people are having to reduce their price. They're not selling. They're trying to get out. We're also seeing that the condos have taken a bit of a hit, and the detached properties are not terrible, but they've also taken that hit as well in Maple Ridge. And when we look at West Central compared to the average, you can see that West Central actually on the detached has fared a little better. They're the ones kind of propping up Maple Ridge from a bigger drop. Certain other markets are definitely going to be lower in that area. So we're seeing a gain of about 5.3% there. Whereas you can see townhouses in the West Central area took a massive, massive hit, down 30.2% on the sales price from last year as an average. So people in that area, from an averaging perspective, are they're down about 100 and just about $70,000. Right, that's a massive loss in that area. Now, again, take this with a grain of salt. It depends on the product types that are selling at the moment, that where this comes from. There's a lot of older townhouses versus newer. That could also bring into the factor of this, but it is very good to know that townhouses may be on sale right now in the West Central area of Maple Ridge. Condos as well, down almost 11%. And as you can see here, days on market are taking longer to sell in most categories. Well, down a little bit in condos and the townhouses, or the townhouses and detached. But the inventory is up on the townhouses and up 35% on condos, down a little bit in this area. And that's probably why we're seeing West Central holding firm on price and detached, is that the inventory is down a bit. All right, North Surrey. We've separated North Surrey and Surrey now because they are two technical sub-markets. Even though they're sub-markets, they're their own markets within sub-markets. So we've separated these out. So North Surrey right now, detached is holding okay at about 1% right now. Days on market is up. Listing inventory is up. Townhouses are down 3.7 and condos taking the biggest hit, down 6.5. Again, when we go back in time and look at what that actually means, you can see here that condos are averaging, they were well over the $500,000 mark, and now we're well under 480,000. So we're looking at like $33,000 in equity erosion in that area right now. Inventory has dropped a little bit, but days on market is rising. Townhouses are up 14% in inventory in North Surrey, and detached up 10%. All right, Surrey as the main body of Surrey. So we're taking out North Surrey, we're taking out South Surrey, and Cloverdale as well. So we're talking, Bear Creek and Newton and things like that. You've got the average down for detached around 4%. The inventory is up. Days on market has climbed quite a bit. Townhouses down 1.5, but condos have taken a bigger hit in this specific area, down 13.3%. When we take a look at what that actually means, we're sitting at a pretty significant loss in the condo market. That's 40,000, almost 60, $70,000, doing quick math in my head there. Whereas, we haven't seen as big a drop in, I think there's a little bit of a typo that my guy put in there. That should be a little lower, but you can see the difference in those areas right now. So big drop in the condo market in Surrey. Now, a lot of you guys have been asking for us to expand our market stats into some other areas, including the Tri-Cities, New Westminster, Burnaby. So we have incorporated some of those for you guys as well. As you can see here, Coquitlam has taken a bigger hit right now than some other markets in the Fraser Valley, down 7.2%, which when you were in a market that's more expensive, that hit is actually larger. Now, when we think about it, a 3% gain on $1 million home versus a $500,000 home, the $1 million home 3% is going to give you more money. But it also means that when we have a 7% hit on the value, the drop is going to be larger as well from an equity perspective. So as you can see here, last year we were sitting at over $1.8 million, 1.819, and now we're sitting at an average of 1,687,000. Days on market have dropped slightly, but inventory has climbed about 6%. The townhouses fared a little bit better, and that is due to an affordability factor. People can still go to that, townhouse if they've got families or anything like that. And they're up about 3% over last year. And you can see the inventory is also climbing. So we might see that start to erode here soon. And then condos have taken a little bit of a hit, down 5.9%, losing nearly, not quite, but nearly $40,000 in equity. And inventory is rising 21.9% right now. Fort Coquitlam, massive hit in the detached market, and it's down 14.8%. What does that mean? I mean, we are averaging well over that 1.54 mark, and now we're sitting at about $1.313 million as an average detached property in Port Coquitlam. And I'm definitely seeing that a lot of people in some of these areas are really trying to hold out on their value, and all it's doing is increasing the days on market. Now you'll see here days on market is pretty equal. It's still taking 38 days, but inventory is climbing at a 3.3%. Not a huge jump, but it is still gaining. Townhouses also took a hit in this market, down 9.2%, and condos down 3% overall. Townhouses were the biggest gain in inventory as well. Heading out to the New Westminster area, detached has fared a little better, down only 0.8%. But again, townhouses took the bigger hit. As you can see here, they were over $1 million for an average townhouse in New West, and now we're at under $880,000. Condos also dropped 2.5%, and some big increase overall in the inventory coming up in a lot of these areas. So keep that in mind that you were starting to probably going to see a little bit more pressure on those townhouses and condos. New Westminster is a smaller market as well. So if people are specifically wanting to be there, great, but it's not an area that's got a huge attraction these days from these perspective, and it's really condo heavy in that market. So if there's a lot of condos hitting the market, we're going to see that pressure put on there. Ruben, welcome. Thanks for joining. Appreciate it. All right, Burnaby North, down 8% in the detached, still over $2 million as an average, but you can see here the erosion in the equity, just under $300,000 in equity lost in that market, down 8%. The inventory is up significantly at 60.8%. Now, townhouses have fared a little better, but condos have not, down 8.8%. And that's because a lot of those areas like Brentwood and Lougheed Town Center have done a ton of condo development, and a lot of those projects are closing. And we're seeing a lot of people flooding the market trying to get those towers sold with their units or assigned, and they're just not moving right now because unfortunately, when they paid to what people are willing to pay now, it's changed quite a bit. And then lastly, Vancouver East, not down significantly over last year, but a 1.5% change means that we are going from just over 2 million to we're looking at about a $30,000 change in that market. Townhouses took a bit of a bigger hit, down 5%, and we're down 4.4% in the condos. So that's kind of what's happening in the market right now. So what do we take from this? As we can see, one, certain markets are being hit harder than others, right? Certain pockets are having bigger drops than others. So here is my take as we head into 2026. Using the data from 2025, we have seen a lot of values come down. So the high watermark was set a while back, and property values have come down quite a bit. Will they continue to go down? That's the big question. As long as we see the inventory start to rise again as we get into the fall market, and we don't see buyer confidence come back at a higher level, then yes, we'll probably see some pressure being put on the market. However, as investors, we got to look at these markets as opportunities to take advantage of, right? As we see sellers needing to get out of properties, we can be that person who does it for them, help them get out and get a great deal while we're at it. And at the end of the day, what we're looking for is stable investments. What we're looking for is not those speculative plays right now. So the strategies that I think we should be looking at going into in 2026 are combinations of just straight up buy, rent, and hold. Buy some properties right now. Millionaires are created in recessionary times. If you can buy properties and the fundamentals make sense, and maybe you need to put a little bit more money down to make the numbers really work. But if you can negotiate hard, you can get properties at cash flow, sit on them. Because at one point, we're going to start to see, as the population continues to grow and the lack of building happens, this market will turn around and you're going to be poised for future growth. The other strategy that I think is really going to be a sexy strategy going into 2026 is the BRRRR method. We're not talking flips right now because obviously you've got flipping taxes and a few other things that may drag you away from that. However, If you can get in, renovate a property that raises that value, find those underperforming properties, maybe adding a suite into a basement, and then renting it out for the maximum amount of rent because you get more rent with nicer units and sit on that property. Now, you're not going to likely refinance right away, especially if we do see some decline in the market still. But if you can sit on that and maybe a year or two from now, you talk to someone like Tim, you refinance, you pull some of that equity out, it's going to be a little bit of a longer play than your typical like get in and out in 6 months, get your equity, do the next one. But that's a way you can start to build a portfolio over time. We have to start thinking as investors and not speculators that we're going to be holding for a long period of time. We're not going to be getting rich in this market in 6 months to a year, like what people were trying to do in 2020, 2021. So keep that in mind as we go forward, that we have to have a little bit more patience in this process as we go. All right. Again, don't forget, take any photos you guys would like. Tag the Kelly Fry team. You can also tag me at Cameron E. Manning on most platforms as well. Happy to see what your ahas there, and I'll definitely share it as well. And we're going to move on to our next speaker here. So I'm going to bring him up on stage as I introduce him. So let's bring up. All right, there we go. Tim, you are on the stage with us. How you doing tonight, my friend?
Hey, good. Can you hear me all right?
I can hear you perfectly. So, guys, if you're in the
Perfect.
chat, drop a 1 if you guys can hear Tim as well. Make sure that everyone else can hear you. Tim, we're going to be taking you through. We're going to be taking them also kind of on a similar track, looking back at what's happened with the mortgage rates over the last year,
hmm
because the number one thing people keep talking about is, yes, mortgage rates are coming down and the market's going to pick back up. So we've seen that now. So we're going to get your perspective on what's happened over the last year. And then again, what your expectations are heading into 2026. So I'm going to basically turn it over to you. If you have any slides you want to share, just make sure you hit the share button on there. You'll see there's a little box with a plus. You can hit that, share your screen, and then I can pop it up on the stage as well. But other than that, I'm going to turn it over to you, Tim.
Perfect. Thank you. I'm just trying to get my screen sharing here. Seems like I got it. Can you see my slides?
You betcha. So I'm going to pop that up there,
Perfect.
and we are live. There we go.
Perfect. Yeah. So we're going to run through a quick update here. And it's before I jump into it, it's just kind of funny. I was thinking about it the other day. I actually bought a place myself last year around this time. And the price of it has come down in the last year and rates have come down. And I was like, man, I could have got a cheaper and with a cheaper mortgage too. So that's kind of a state of where things are at. Um, just getting started though. Right now, money is on sale. Rates have come down. So I was looking at this as I was putting this together. We're at about 10% off compared to last year and 37% off compared to 2 years ago. So, in the spirit of Black Friday, I wanted to start with, a money's on sale right now. But what does that mean overall? So I'm going to run through a few different things here today. Going to talk about the rate updates, some policy updates. There's been some interesting policy updates. Some have been well publicized, not all of them. So we're going to touch on a few of those. And then I wanted to leave you with some tips and tricks on what you can do to increase your approval amounts, especially investors with portfolios. It's when you start getting a few properties, it becomes imperative to use some good strategy to make sure you're maximizing your approval amounts. So jumping into the rates, I just wanted to kind of level set here, quick refresh. We got two types of rates in Canada. We got fixed, we got variable. Start with variable. So variable is going to be based on the lender's prime rate, which is driven by the Bank of Canada's overnight rate. The overnight rate gets set 8 times per year. And when you get a variable mortgage, it's expressed as a discount from prime. So prime currently is 4.45%. So if you got a mortgage today, let's say you get prime minus 0.5%. Your actual rate would start at 3.95%. So just a key detail, when you are talking about a variable rate, the really important part to look at is the discount from prime. We also have two types of variable rates. There's an ARM and a VERM. An ARM is adjustable rate. VERM is variable rate. Adjustable rate means as the rates change, so does your mortgage payment. A VERM means as the rates change, your mortgage payment stays the same, but the amortization gets adjusted. So just two key details there. The reason I wanted to bring this up is something that gets asked. I get asked all the time is, I'll have clients call me, the Bank of Canada will lower rates and, maybe they're approved for a fixed or something like that. And they'll call me up and say, hey, I hear rates are coming down. What does that mean for my fixed rate? In reality, it doesn't mean anything. When the Bank of Canada changes their rates, that does not directly impact fixed rates. Fixed rates are priced differently. If you think about it, like let's say you're going to lend somebody money for 5 years, you're not just going to pick the rate today. You're going to pick, what you think is a fair rate over the next 5 years. That's what the banks do as well. A good barometer to watch for this, if you want to know where fixed rates are going, is the 5-year bond yield. It's not exactly how banks price their rates, but it gives us a really good indication of where fixed rates are going to go. And typically fixed rates are a lot more forward looking than the variable. And I believe it was either the last rate cut or the one before. The 5-year bond yield actually went up a little bit after the Bank of Canada cut their rates, because they're looking ahead to what was coming next. All right. So kind of just going back through it, the story of the fixed rates. And again, right here, there's so many different rates, fixed, when we're talking about fixed, 1 year, 2 year, 3 year, 5 year, etc. But for today, I'm just going to talk about the 5-year, just to do a quick comparison. So you can see here, this is the 5-year bond yield. The 5-year insured mortgage rate pretty well matches the shape. It smooths out some of the ups and downs and the volatility, but it really has the same shape. And so, we started the year up here, came down. The lowest rates were around March or April, which coincides with when bond yields hit a 3-year low. That was in April. That was coincided with that tariff D-Day announcement down in the US when all the markets sold off. So since then, the bond market recovered, or the bonds yields, recovered, and fixed rates came up a little bit. Started to come down a bit in October, and then have crept back up a hair just the last month or so. So that's kind of the story of the 5-year fixed, but still down, even if it's come back up in the last month or so, still down quite a bit from the beginning of the year. Now, when we flip to variable, we can see the variable, we've had 3 Bank of Canada cuts. So the Bank of Canada cut February, and then they cut in, August, and then, or September, and then again just recently last month. So we started the year with the Bank of Canada overnight rate at 3%, and the Bank of Canada overnight rate is now 2.25%. But really, it kind of drives me nuts when all the news put out there, the Bank of Canada rate is now 2.25%, because that's not the rate that anyone's actually going to get on their mortgage. You're going to get a mortgage rate based on the prime rate, which is this guy up here, which changes with the overnight rate. It's now at 4.4%. So and then you're going to get a discount from there. So just for quick math, every 0.25% in rate cut saves you about $15 per 100,000 per month. So this year, if you have a variable rate mortgage, you've saved about $45 per 100,000 borrowed. Looking at how the fixed versus the variable has changed this year, this is kind of interesting. For the last 3 years or so, fixed rates have always been lower than variable rates. But as of the last rate cut here, we saw a flip. So just before the last rate cut, they're kind of almost in the same spot. Once we got that last rate cut, it really came down below it here. So interesting to note, though, we're still not seeing as many variable rates, even though variable rates are lower than fixed. Only about 25% of originations right now are variable. And I think there's 2 reasons for that. I think people are a little bit gun shy from what happened during COVID when rates really spiked. And I also think the market's not convinced that rates are going to keep coming down. So, and that's kind of where we're going to go next is, not quite next, sorry. I wanted to just give a brief interlude with the recent history of prime rates. So the average prime rate since January 1, 2000 is 4.06%. And from, just after the financial crisis until 2017, prime was under 3%. So that was kind of like that zero interest rate policy era. And today we're sitting at that 4.45. So you can see we're a little bit above the recent historical average. So yeah, anyway, I just want to put that out there for context. Potentially maybe some room to come down some more. But if you look at what the Bank of Canada is telling us, they've indicated they're likely done cutting rates. After their last meeting, they put out their minutes, and to paraphrase boring bank speak, they basically said, we're good here unless something really forces our hand. The market tends to agree. So there is like kind of a betting market, if you will, for where interest rate policy is going to go, and basically people use it to hedge their exposure on other investments. And what that tells us is where the market thinks rates are going. And for the next meeting in December, there's a 9% chance of a cut, and in January there's a 13% chance of a cut. So basically nothing. Forward, projecting out the next 5 years, the projection is flat for the next year, starting to increase in 2 years, and then going up again 4 years, but and then up again in 5 years. But I mean, I think it's all we know for sure is that this is wrong. We don't have no one has a crystal ball. It'd be highly unlikely if they just nailed this. But it gives you an idea of what the market's thinking. And I just tend to think that just 0.25% increases every 2 years or so for the next 4 years seems unlikely. If we do move, I think it'll be a little bit more up, or if it comes down, a little bit more down. But just giving you an idea on where the market thinks things are going. So, like I said, nobody has a crystal ball. We don't know where things are going to go, but I like to, when I have clients ask me, should I take a fixed or a variable? Where do you think rates are going? I give them the information we just talked about, where the market thinks, because that's people actually betting their money on where they think rates are going to go. And then also, what are the factors that I'm watching that are going to increase where rates are going to go? So, what's going to drive rates up? So, the Bank of Canada has a mandate to keep inflation down. When inflation gets up too much, that's when they will increase rates. So, if we get increasing inflation, we will get increased rates. What could cause that increasing inflation? If we get more tariffs, now there's a lot of debate out there if tariffs are inflationary or not, and I'm not going to get into that debate. But it is certainly something that could cause inflation. If it does, that would lead to higher rates. Global conflict, we seem to be in a world where there's always something kind of just brewing around the corner. If we do get global conflict, that will increase inflation, which would impact rates, and increase government spending. So, our government just released their most recent budget with a pretty hefty deficit and some spending. And I'm not going to get into whether that spending is good or bad, but what it does mean is that if where that money is coming from, it's coming into that economy, and that is kind of inherently inflationary and is kind of a risk factor, in my opinion, for increasing borrowing costs. Other things that could increase mortgage rates, if we get some strong jobs reports, a strengthening economy, or if bond prices start to go down. So bond prices and bond yields are inverted. So if bond prices go down, that means bond yields will go up. Bond prices going down, if investors start to lose faith in bonds and they're not that safe haven that they thought they were going to be, they don't. What concerns me is not just Canada, but a lot of countries around the world have, pretty large deficits. And if investors kind of lose faith in that and start selling off their bonds, that will drive the price of bonds down, which drives the bond yields up, which would drive interest rates up on the fixed side anyway. What can bring rates down? If we get some poor jobs reports, if our economy kind of tanks, then that would certainly give the Bank of Canada some reasons to lower rates more. One thing I'm really watching is the free trade agreement that is up for renewal next year. I think all parties want to get it renewed. It's definitely, from my understanding, beneficial to all parties to get it renewed, but there has been some talks that the US might just pull out of it. If they did that, the reports that I've read, I think it's like a 5% hit to Canada's GDP, which would be really, really significant and really hamper our economy. And this could be a scenario where we could see rates come crashing down. So that's kind of the black swan. I guess it's not a black swan if we're thinking about it, but it is a major impact that could be coming and is worth keeping an eye on. The other thing, if inflation comes down, rates could come down. And the last one, and I try not to get too much into like conspiracies, tinfoil hat, or anything like that, but I do think it is worth paying attention to that our prime minister was a former central banker. So I think he must have friends in the central bank. And it's great for our government if rates are down, because they're borrowing. They have a huge deficit. They're borrowing. It decreases their borrowing costs. So there's not supposed to be any kind of connection between the Bank of Canada and our government, but it's not too big of a stretch to think that there might be, especially with our current prime minister being a former central banker himself. So those are just what I'm watching on where rates could be going. And as I mentioned, rates have come down last 2 years a lot. Even the last year, they've come down quite a bit. And so how does this help? How does this help borrowers? So I wanted to just kind of do a bit of a dive here on how it helps. So um, to do this, we have to understand the foundation of mortgages. On the residential side, at least, this is our debt service ratios. So what is a debt service ratio? A debt service ratio shows the percentage of your income that can be allocated towards paying your debt. So the way I like to explain this is, let's say you make $1,000 a month in income. Nobody's going to give you a mortgage that costs $990 a month because you have $10 a month left to eat, sleep, pay tax, like recipe for disaster. I think everyone can see that. So, okay, so what about $980 a month, 970? Like where is that line where it becomes acceptable? So the regulators have kind of drawn a line, and they said about 39% of your income can go towards paying your mortgage and other housing fees, and then 44% of your income can go towards paying your mortgage, housing fees, and any other debt you might have. So these are the debt service formulas. These are something that I do every day when we're looking at qualifying. Key detail here is 50% of strata fees. We only use 50% of strata fees in the housing costs. All right, so we're going to do a little bit of a test on the next slide, and it's not too hard of a test because the answer is right at the bottom, but I just wanted to kind of walk through this example together. So, if we look at a family, let's say they make $120,000 a year, which works out to $10,000 a month. Their mortgage payments, their stress tested mortgage payments, $3,000 a month. Taxes 150, heat 100, strata fees 400, and a car loan of 500. Their GDS we'd calculate as 3,000 plus 150 plus 100, so that's 250 plus 200 because we're only looking at half of here, so 450. So 3,450 out of 10,000 gives us 30.345, which works out to 34.5%. If we add in the car loan for the TDS, we're at 39.5%. So that's how we're calculating that. And where this comes into play is, because these ratios are fixed, we're only allowed 39 and 44. If we're talking insured mortgages and other lenders, we can go higher, but we'll get to that later. But assume we're only limited to 39 and 44. That is what limits our maximum mortgage amount. So if we go back to November 2023, when rates were 6.39% and we were qualifying at 8.39%, in our fictitious example here, your maximum mortgage amount is $459,000. Fast forward to January of last year, when rates are 4.39%, qualify for 556. Right now, call it 399, you can qualify for 580. So that's a 26% increase in purchasing power over the last 2 years and a 4% increase in purchasing power over the last year or so. All right, so that's just how impactful lower rates can be. And when we look at this when it comes to the market as well, if people, nobody has, let's say your income stayed the same. Well, now over 2 years, you went from being able to borrow 460 now to being able to borrow 580. Maybe that makes you more likely to want to buy something. Maybe it puts the places that you're looking at back into your price range, brings out the buyers. So that's why kind of the general theory is, if rates come down, prices might be inclined to go up because people can afford more. The interesting thing is, to me, we're in a bit of an environment where prices have softened and rates have come down. So that provides kind of that interesting data point there. Switching gears now into the updates and rumors section. I wanted to touch on a few important things that have happened in the last year and what might be coming up. So the first one, this has probably been the most impactful change that I've seen, was the 30-year amortization on insured mortgages for first-time buyers or new homes. Previously, if you had an insured mortgage, you could only get a 25-year amortization. As of December last year, they said, okay, first time buyers, or if you're buying a new home, you get a 30-year amortization. This has been really impactful. It's every first time buyer that's got an insured mortgage that I've done this year has opted for a 30-year amortization. From what I've heard in the industry from colleagues, that's holds true for everyone. And why that is, if let's just look at our example again of $120,000 household income, that increases your borrowing capacity by $45,000. Or if you don't want to increase your borrowing capacity, it reduces your monthly payment. So again, this is something that could also be considered slightly inflationary on the housing market, because if people can now borrow more, they might be inclined to push their prices higher. So obviously that hasn't played out in the last year, but it is something to keep an eye on, that could fuel the market a bit down the road. On kind of the same theme, on insured mortgages, the maximum purchase price was raised from 1 million to 1.5 million. Yes, and I don't have the chat open, Cameron, so feel free to pop it in where I can see it. I don't know how to have the YouTube and this one open, so I think you can chat with me if someone has a question. Just pop it in here, and I'll definitely answer it. But where this increase in max purchase price kind of plays in, is hasn't been that impactful. I've done a handful of them, but the reason it's not that impactful is it's pretty hard to qualify for a $1.5 million purchase on an insured side, like with a minimum down payment, because if we're looking at 1.5 million, minimum down payment's 125,000. You're going to need about 280,000 in household income to qualify for that. So, in my experience, that much household income, those borrowers typically have enough to make a 20% down payment. The next one that's supposedly coming, who knows, is this GST removal on new builds. They announced it, I think, in April. Currently, there is a bill, I guess, that's been tabled if you read the website. So it's not actually available, but it has been tabled, and it does look like it's going to happen. It sounds like it might just be a rebate, though, not an actual, like they're not actually just wiping it off. So it's something that you might have to kind of pay and then get it back. So something to keep an eye on. Hopefully it happens. Hopefully they just remove it all and it's not just a rebate. But that, will hopefully have an impact. Something that's probably lesser known about is this LTI, loan to income restriction, that took effect last year. This is only on the bank side, so it hasn't been well publicized, but I do think it's worth keeping an eye on, and I'll talk about why in a sec. But how it works is essentially they're limiting banks to the number of mortgages where the loan is more than 4.5 times the borrower's income. But they're kind of doing it in this weird way where they're saying, okay, 20% of your portfolio can have mortgages above 4.5 times income. But the bank down the street, they could get 15% of their portfolio. Bank up the street, they could get 25%. And they're not telling anybody. So there's just like weird black box where there is these loan to income restrictions placed on the banks. Different banks have different restrictions, and nobody knows, or the general public isn't made aware of what banks have what restrictions. This year so far, it hasn't had any impact on approvals that I've seen or that I've heard about. However, if rates drop below that 3.25% threshold where the stress test kind of changes, this may become more of a limiting factor. And approvals could depend on who has that LTI room. So if we start to see rates come down more, then you could have a great file and just need a bit higher LTI, and one bank may say no because they're out of room, and another bank may have room and accept it. And this is just a chart here showing the percentage of mortgages with an LTI above 4.5. So this line here is the 15% line. So as you can see right now, we're well below the 15% line. We're around 12%. So we have some room before anyone would be impacted. But as you can see, during that COVID era here, this is a time if everyone was limited to 15%, all of these would have been declines. Or, if your bank was limited, you might have had to go somewhere else. So that's where this could come into play. And especially with one of the rumors, the first rumor I wanted to bring up is that there is a rumor that this loan to income test may replace the stress test. So that's kind of why the OSFI has brought it in kind of last year, not really talked about it. Supposedly they're doing like a test. They've been running it now for a year. And I believe in the UK, this is more how they do things. So there is, rumblings that the stress test may go away and it may be the LTI limit that replaces it. So there's pros and cons to that. Since it would be at the institutional level, not a borrower level, it kind of makes approvals a bit more of a black box. Again, especially if we don't know who has what room, what everybody's approval amount is, or what everybody's threshold is. And so it makes it a bit more of a black box. But the good news is that it would actually increase borrowing capacity at higher rates. Of course, it would limit borrowing capacity at lower rates. So it's just some things to think about. And we kind of expect to hear news by spring of next year. I don't think this requires any action from anybody at the moment. If they announce something next year, I'm sure it'll be like kind of a gradual rollout. I don't think anything dramatic will happen immediately, but this is something I'm certainly keeping my eye on. There was another regulatory change that supposedly happened that kind of blew up on social media, and I just wanted to provide some clarification because the posts about it got pretty viral, but then when it got walked back, it didn't really go viral. So I just want to make sure here no one here was worried about it. Basically, what happened is a broker misinterpreted some OSFI guidance and made some posts that went viral. They What they thought OSFI was saying was that if you use salary to qualify for one property, you can no longer use that salary to qualify for mortgages on any other properties. I kind of saw that and I was like, that doesn't make any sense because if you just went to a different lender, they'd have no idea how you qualify for that other property. Turns out that wasn't what actually happened at all. OSFI came out and confirmed that there's no actual underwriting changes being made. The goal of the change that did happen is they're trying to classify mortgages that are materially dependent on rental cash flows. And they're defining a property as materially dependent on cash flows if more than half of the income used to qualify that property came from the property itself. The impact of this is that they have higher capital requirements for the lenders on those mortgages. So there could be a trickle down effect where because lenders are required to hold more capital if they have more materially dependent mortgages, they might be less inclined to lend on those. But there is no direct underwriting changes. And so far, I haven't actually seen this having an impact. So I did want to clear that up in case it was something anybody was worried about. Okay, now the kind of the last section we're going to go through today. I wanted to provide some tips and tricks for increasing approval amounts and just general other things to think about when you're looking at if anyone is looking at a mortgage. Most investors need mortgages at some point. So let's look at some tips and tricks. So the first thing that's really important to understand when you're looking at a mortgage on an investment property is lenders don't look at cash flow, at least on the residential side. So I get calls all the time from an investor, and they'll be like, "Hey, this mortgage is $2,000. I'm going to rent it for 2,500, so $500 a month cash flow should be good, right?" But unfortunately, that's not how the lenders look at it. What they do is they use either an add back or an offset. So how that works is an add back. If we look at our total debt service equation here, an add back adds a percent of the rental income to your gross income. So they just add that to your income. An offset is going to remove a percent of the rental income from your mortgage payments. So that is more looking at it like a cash flow. However, they're only looking at a percent. They might say 50% can offset your mortgage payments. They don't let you do the whole thing. And different lenders have different policies. Some lenders use add backs. They have different percentages of add backs. Different lenders have different percentages of offsets. So it's really important to make sure you're kind of, if you're looking for an investment property and your ratios could be tight, you want to be exploring all options, making sure your broker is looking at what all the options are. And I want to run through an example of why this really matters. So look at my favorite couple, Mr. and Mrs. Sample. Let's say they have a household income of 160,000, and let's say they currently live in a townhome. It's worth 800,000. They got a $525,000 mortgage. Monthly payments $2,500 a month, and they're looking to buy a new place with a suite. They're going to rent out this townhome, and this townhome can rent it for $3,400 a month. Say there's $300 a month in strata fees, and they have some other existing debts. So they live in a townhome. They want to move to an owner-occupied property, a freehold with a suite, and they're going to rent that townhome. So how does this look? And I'll give you an example of two different lenders. The first one, Scotiabank. Sure, everybody's heard of Scotiabank. This is their rental worksheet for the townhouse. So this is how they account for the debt that the townhouse brings to the application. So they take the monthly rent, divide it by 2, and then subtract the mortgage payment. What that does is they're left with a shortfall of $800 a month. So that $800 a month gets added as a debt to the overall equation. All right. When we look at another lender that has a really favorable policy for this lender is called Strive. They're a monoline lender. They have their rental worksheet, and ultimately with their rental worksheet, you end up with a surplus of $5.20. What that means is you can take that $5.20 and add it as monthly income. In reality, it doesn't really help a lot, but it's way better than having to account for an $800 a month debt. When we look at how this affects purchasing power, Strive, same application, $253,000 more in purchasing power. And there's also, and not just because of the last two with the $800 debt versus $5 income, they also allow you to add 100% of the suite, the legal suite to your income, and remove taxes and heat from the debt service equation. So that's just the other reason that their approval amount is much higher. So you can see here, $878,000 maximum mortgage. With Scotia, you'd be looking at $650. So huge difference. And you can see the ratios are the same. They're both within that 39-44. So, lender policy makes a really big difference when it comes to getting approved for an investment property. That was the first kind of tip I wanted to put out there. And the next one I want to talk about, buying your first investment property. So I don't know if we have seasoned investors, first time investors, but I'll throw this out there because everyone knows someone who's a first time investor, and I think this is pretty good advice. So if Cameron says we have both, this is great. So if you're buying a rental property, if you're just going to go out, you're going to buy a rental property, you need 20% down payment. That's the rule. If you're buying an owner-occupied property, minimum down payment is 5% on the first 500,000, 10% on the rest, up to that 1.5 million I mentioned earlier. So what this means is that if you already own a home, the easiest investment property to buy is the one you already own. So, and that's exactly what we just looked at with Mr. and Mrs. Sample. They owned their townhome. They were able to go buy another place with 10% down, move into that, and then rent out the townhome. And theoretically, they could have bought that townhome with 10% down, lived in it for a little bit, and then, it's time to upsize. They had some kids. They wanted a freehold. Now they're going to upsize, move to that freehold, 10% down on that one. And, that's the easiest way to kind of get started in the investment game. And it's really, really common, young people, you buy a condo, first property, then you get ready to upsize, keep that condo as an investment as you maybe upsize your family to a townhome or freehold. The other benefit to doing this is if you are a first-time buyer, there's no first-time home buyer benefits if you're buying a rental property. So buying, a small owner-occupied place as your first property that you live in for a while allows you to take advantage of all those first-time home buyer benefits. Then later on, you can convert it to a rental. So, this is more of a long-term strategy, but I think, when we're looking at real estate investing, it is a long-term game. My grandfather always said to me, get a seat on the bus and you can trade seats later. And that's exactly what this is. You get your seat on the bus, you trade seats later, convert it to a rental. And I mean, there's no limit to the amount of times that you could do this. You know, converting your owner occupied home into a rental and buying something new. So again, just going back to that Mr. and Mrs. sample. So let's say they want to stay in their townhome. They're going to buy that new freehold with the suite as an investment. So you got up, you got down. Say it rents for $4,000 a month. In this scenario, you're limited to a $528,000 mortgage, which is, you know, over $300,000 off from that 878 we had. So, and if you wanted to keep that same 976 purchase price, they would need a $448,000 down payment. So just kind of comparing these two scenarios. First one, so they're in the townhome. First scenario, flip the townhome to a rental, buy the freehold, rent the bottom. Second scenario, stay in the townhome, buy the freehold, rent the up, rent the down. You need an extra almost what $330,000, $340,000 in down payment to do the same thing. So it's a huge difference, and why this strategy I think is important to consider. The next thing, mortgage helpers. How much do they help? So mortgage helpers actually help quite a lot. So just a quick scenario here. I won't run you through all these numbers, but basically same income, you know, tried to make the housing costs relatively accurate. So this one we're looking at a townhouse with 10% down. This one we're looking at a freehold with 10% down. And the freehold has a suite income of $1,600 a month. That's going to give you an extra approval amount of $205,000. So that $1,600 a month in suite income lets you stretch your purchase, or lets you stretch your mortgage by an extra $200,000. So mortgage helpers help significantly. The next little tip I wanted to talk about is just making sure you're aware of the 3 different types of lenders that we have, and when and why they're useful. So the first type, you know, so we have prime lenders, we have alt lenders, and we have private lenders. Prime lenders, you know, banks, credit unions, mortgage finance companies. They do insured mortgages, they do conventional mortgages, they have your best rates, but they also have your most restrictive qualifying criteria. Alt lenders typically come with a 1% fee. They have slightly higher rates than your prime lenders, but they're way more flexible. Credit scores, ratios. If you're self-employed, you know, if you're self-employed, they have options where you can, it's called stated income. You can literally write down how much your income is, and as long as it generally makes sense, doesn't have to be what you're declaring on your taxes, they will use it. Downsides here is, like I said, a little bit higher rates. They can be a bit restrictive around location. Lower mainland, we're totally fine. Property use, I mean, no using it for farms, stuff like that. LTV, sometimes they may want more than 20% down. It's always minimum 20% down with an alt lender. Sometimes you may need a little bit more, but they're very, very flexible when it comes to a lot of the other items. Private lenders are most expensive, highest rates, highest fees, but they have the lowest qualifying criteria. As long as you have equity, you can typically find a private lender who will do it. And so just kind of on that note, running through, I wanted to run through a couple different comparisons of your mortgage approval amount by mortgage type. So assuming $120,000 a year in household income, small car loan, and we're going to put different down payment amounts. So if we look at an insured mortgage, 10% down, 25-year amortization, you can borrow $540. Now, your first-time home buyer, let's say, okay, insured mortgage, 10% down, you can borrow $580. So there's that $40K increase in borrowing ability. Okay, but now let's say you go conventional with 20% down, your max mortgage amount goes up to $664. The reason for this is when you have 20% down, even with a prime lender, they will stretch your ratios so that 39-44 becomes a fuzzy 39-44, and you can go, 45-45, 47-47. So that allows you to stretch this. Alt lenders, if you have 20% down, even though they have a higher rate, you can get a much higher maximum mortgage because some of these lenders will let you go up to 60% GDS and TDS. So much, much higher ratios here. So just, same kind of client profile, different down payment amounts, obviously, but maximum mortgage amounts vary dramatically depending on the lender type. I want to give a few tips for higher approval. So first one is, if you're financing items, whether it's a house, a car, whatever it is, consider taking the longest possible loan terms or amortization, because that reduces how much that debt will count against you on future applications. You can use prepayments to manually reduce the amortization. I'll talk about that strategy a little bit more, I think on the next slide or the one after. But that's something to think about there. If you are financing things and you are planning to apply for more mortgages in the future, making sure that whatever you're getting has the smallest payment possible. Typically, that's by amortizing it out over the longest term. If you do have rentals, consider including utilities in your rents so that your gross rent is higher. So when we do that add back or offset, the amount we're able to use ends up being more. If you have debt obligations, keeping them to 5% or less of your gross income means that because the GDS and TDS 3944, that 5% difference will allow you to maximize your borrowing ability if your debt obligations are 5% or less of your total income. And the last one here, 50K plus credit limit trick. So this is this isn't with every lender, but we have a few where it works like this. So let's say you have a line of credit of $40,000 with a $40,000 limit, and you have $20,000 balance on that. In that scenario, we would have to take 3% of that, so like $600 a month. That would be what gets counted against you in the debt servicing. But if your limit is $50,000 or more, we can actually amortize that over 25 years at 5.25%. So that brings that monthly payment down to, I forget exactly what it is on that example, probably like $200 or $300. So it makes a huge difference. So that's not actually spending more. It's just making sure that that limit is over lines of credit in that range that you do use. Having a limit on them over $50,000 can make a huge difference on approvals. Now, again, not every lender will do this, but we definitely have some. Oh, right. Yes. So I'll get to the extending amortization tip later. But first, we're going to talk about a new product. So this is something that I get asked about all the time. And up until now, I always had to say no. So people are like, hey, I don't have tons of income, but I do have a lot of equity in my real estate portfolio. And before that had never helped. We have net worth programs where if you have liquid assets, that can help you qualify for more, but real estate's not considered liquid. This is a new product. It's an alternative lending product, but it allows you to use your real estate equity to help you qualify. You can also use, other liquid assets, and I'll kind of run you through it here. So if you have GICs, TFSAs, we can use 100% of those assets. We can use 75% of your stocks or bonds, 65% of any retirement assets. And for real estate, how they calculate it is they take your property value times 80% less encumbrances, which is just fancy word for mortgages. So, and then what they do is they take whatever the asset value is and divide it by 120. So basically 10 years, and they call that your monthly qualifying income. So 100K TFSA gives you an extra $833 a month. 100K RRSP gives you $542 a month. And the real kicker, this is the great part about this, is let's say you have a $500,000 property with a 100K mortgage. So how we would do that is we take that 500K times 80%, so 400, less $100,000 mortgage gives you 300. Divide that by 120, gives you $2,500 a month in extra income that we can add to your application. And not only that, but this product allows extended ratios up to 55%. And there is no stress test, and you can get a 40-year amortization. So it's qualifying for this is quite a lot easier than a lot of other products. But there is a 2% fee, and as you can see, rates are going to be a bit higher. The rates will depend on your loan to value and your credit score. If you have a low loan to value, less than 65%, and a good credit score, you'd be looking at 5.25% or 5.24%. There are some premiums here. If you're buying a rental property, then you'd add 0.5%, second home, etc. But this is a great product for anybody who wants to buy something, has lots of equity in properties, and just not enough demonstrable income to qualify. So yeah, it's a new product that I'm pretty excited about. Yeah, so this is where I was going to get into that other tip I mentioned earlier. So just a lot of people bought 2020, 2021. You took a 5-year mortgage. A lot of people are up for renewal around now. So I did want to just leave you with a few things to think about if you are or someone you know is up for renewal. Talk to a broker. Obviously, I would love it if you talk to me. But if you don't talk to me, talk to a broker. If you just go to your bank and sign whatever they're offering you, you're probably leaving money on the table. So talk to a broker, let them shop around for you. Because it's not just about the rate that you're going to get. Like, we can strategize, how are we, especially if you're an investor and you have a portfolio, how is what we do with this renewal setting you up for future borrowing? And that kind of ties into my next point of, if you are going to make changes to your mortgage, renewal is the best time because there is no penalty to change anything. So whether that's adding a HELOC, refinancing to pull out equity or consolidate debts, you can do all of that without like a penalty on your mortgage. Where if you did that midterm, there would be a penalty for doing so. And the other one, I kind of touched on this earlier, is you can also adjust your amortization. So if you are an investor, or even if you have kids and you plan on maybe needing to co-sign for them, it can make a lot of sense to extend your terms. Because if you say I don't know, say you have 20 years left, and you at renewal, we readjust it back out to 30 years. Like, I get it. Nobody wants to just like have a 30-year mortgage forever. And I don't want to be the mortgage broker that just saddles you with debt forever. That's not the point. But if you take a 30-year mortgage, your monthly payment is going to be lower than if you took a 20-year mortgage. And if you're planning to buy something else in the future and we have to use that to count against you, it will actually increase your borrowing power down the road. So even if that's with co-signing for kids or anything like that, it still comes into play. And every mortgage has prepayment privileges, meaning you can pay extra on your mortgage. Any of those extra payments go directly towards your principal. So I can tell you what the difference would be between a 20-year payment and a 30-year payment, and you can just make that extra monthly payment yourself every month. I call this manual amortization reduction. So you're just manually reducing your amortization. But when it comes time to do another application, the amount that counts against you is minimized. So that's where that makes sense. So yeah, those were all my tips for renewal. The last thing I wanted to leave you with is just a quick plug. I have a mortgage monitor that I use for all of my clients. It sends out a monthly personalized home ownership report, includes estimated home value, any potential savings opportunities, how much buying power you might have, how much equity you can access if you want to do renovations or make investments. And I've used this to save my clients. I have examples just this year. I think I've saved over $15,000 for clients just with opportunities that my mortgage monitor flagged. Each client that I put in it, there is a slight cost, but I do it for all my clients for free. And for anybody here today who's interested, if you scan that QR code, I will add you to the system for free, and you can start receiving a mortgage monitor report that gives you all of those great things. And if there is ever an opportunity to save money on your mortgage, I will reach out and let you know. And I believe that is all I had. So there's my info. If you ever have any questions, as you might have noticed, I love talking about mortgages. So if you ever just want to talk about mortgages, like, I'm your guy. But yeah, thank you so much. I really appreciate everybody's time. Yeah.
Awesome. Well, thank you so much, Tim. We have started having a few questions coming in here, so I'm just going to pop them up on the screen. So yes. First one from Ruben here.
Ruben, yes, that is Aveo, the Flex 40. Sorry, I'll read the whole question in case anyone can't see it. The Flex 40 that I talked about with the real estate equity, that is offered by Aveo, which is the alternative lender of CMLS. So far, it's only one lender.
Okay. Also from Ruben.
Yeah. How does it work when the portfolio is in a corporation and we are the main shareholders in that corporation? So that Flex 40 is in personal name only, unfortunately. So if this ties in with that last question, it's not applicable. If your rental portfolio is in a corporation, there are lenders that will lend, obviously, but you are more limited, and there are less lenders who will work with kind of corporates. But as long as you're the sole shareholder and the debt service requirements match up, usually you're going to also need a personal guarantee. There are likely options.
Great. All right. And we had just a comment from Michael Noel. Awesome presentation.
Thank you, Michael. Appreciate that.
All right, guys. Does anyone else have any other questions? Make sure you guys throw it in the chat here. We'll pop it up on the screen for Tim to see. Now, Tim, one question I have while we wait for other ones to come in is obviously, we've seen a lot of doom and gloom, and I'm really happy that you pointed out that whole OFSV issue that everyone
Yeah,
was freaking out about. I mean, I saw
yeah,
so many videos talking about it,
yeah,
right? So I'm glad you brought that up because I was going to bring that up.
yeah,
Speaking of, it looks like obviously there's some programs that are going to be beneficial to investors going forward instead of restricting them, like that one you just showed with the net worth, with which I know a lot of investors out there are at that point. They've been investing for
yeah.
20, 30 years and they've got equity, but maybe there's going to retirement. What are some strategies right now that you're seeing investors taking advantage of right now that going into 2026, other people should be maybe considering and thinking about for their own portfolio?
Um, yeah, so the first one is like if a lot of people are renewing in 2026, and if you don't have a HELOC, add a HELOC at renewal. Like you said, maybe this isn't the time you want to buy, maybe you're waiting it out. But if you are renewing, add a HELOC, and then that's something you can draw from later if you need access to that cash. Especially like you said, if people have been investing for a long time and you're approaching retirement, this is actually probably the number one tip for anybody who is in that scenario, whether you're an investor or not. Um, Add a HELOC before you retire. Once you have retired, your income that you're not going to have the same income. You probably won't qualify to add a HELOC. So if you want to be able to access that equity in your home post retirement for whatever reason, I don't care. Maybe just even emergencies. Add the HELOC before you retire when you can still count your full income. So that would be a tip. The other one I've done recently, and it's actually kind of funny. It was the last time I was at IPG, I talked about reverse mortgages, and so I have one investor. He's a retired gentleman. He actually owns two properties in Hawaii, free and clear, and he's their cash flow properties. And he's buying another property here in BC. But he has his pension income. The rental properties in Hawaii are great income producing assets, but he hasn't had them for 2 years, and they're in the U.S. So the amount of income we can use from them is basically nothing. So we can't really show any income for him. But we're able to use a reverse mortgage, and he's able to buy a property here. He's actually buying a property on the island in a location where it can be used for Airbnb. So he's actually doing a renovation with some of the extra funds we're getting from the reverse mortgage, and he's gonna. I was talking to his realtor, and she said, "Man, I'm so jealous. This guy's gonna make a killing on this place." So it's a reverse mortgage. The rates are higher than a regular mortgage, but that is something where because his income is like not really qualifying for anything. We can use a reverse mortgage to kind of get him in there and allow him to make a killing on this property.
Excellent. I know. Yeah. Last time we had you, I was looking back on it because I was trying to see when that was, and it's almost over a year ago at this point now since we've had you come and do that reverse mortgage talk. So it's
Time
it's
flies.
something that I'm hearing a lot more people talk about as well. Just over time, I think
Yeah.
reverse mortgages had a bit of a bad stigma there for a while,
Yeah.
but they seem to be coming to a new light. So maybe you can expand a little bit more, on the benefits for those
Mhm.
who might look at that as an option right now.
Yeah, and actually, since the last time I talked, we actually have a new lender offering them, Home Trust, who is a great alternative lending partner of mine that's in the space, a great alternative lending partner. They just launched their reverse mortgage product. But what it is essentially, if you're 55 or older, you don't need income to qualify for a mortgage. A reverse mortgage is basically a life mortgage. It'll grow over time, and no payments are required. You're allowed to pay interest only to stop it from growing over time. So the downside is that it's going to grow, it's compound interest working against you. But the upside is there's no payments required, therefore there's no income required to qualify. So kind of, I mean, I think I spent a whole hour last time going through it, but just in a kind of a short answer, that those are the benefits. So scenarios where it's useful are the one I explained, or people who just want to retire and in their own home, and they don't want to have to downsize, but they need some equity out. That's a way for them to get equity out.
Right. Excellent. Excellent. And that one is still available on the live streams here. So every IPG that we do, guys, You can rewatch any of our past IPG events as well in the live tab on the Cameraman YouTube channel, exactly the channel you guys are watching this one on right now. So you can go check his past one out as well to catch up on that one. Also, I'm just going to throw this out there. If you guys are watching this and you're not already subscribed to the YouTube channel, you will see a button right below. It's probably going to be right below Tim on the screen. Click that. Make sure you guys are subscribed. Help me grow this channel, and we'll provide a lot more great content going forward for you guys. Tim, I just want to thank you so much again for joining us. I think, honestly, I learned a lot myself. I'm gonna have to rewatch it as well because you covered so many different points, but I think it was very, very valuable. One last thing I want to ask before you jump off is 2026. What do you
Yeah.
see as the opportunity for investors going forward?
I see the opportunity as kind of what I open with is that prices have come down and rates have come down. And that is an unusual thing. Usually if rates come down, prices go up. So money is
Mhm.
cheaper and houses are cheaper. If
Yeah.
you know, to kind of sum it up. And where does that stop? We don't know. And you never know. But I think that is the opportunity that I see. And I've seen some great deals out there.
Mhm.
And so I think there is opportunity for that. And I like just some of the clients that I've seen, like, I get to see all the purchase agreements, and like they're coming in way under asking on a lot of these. And like, if you're willing to negotiate and throw some lowball offers out there, and like I said, money is cheap, and if you can get a house for cheap, there could be some good deals to be had. So those are the opportunities that I see.
Awesome. Well, I appreciate it. Final question. Thoughts on the stash? It's
Man, I
November.
love it. I wanted to lead with that. I didn't really have an opportunity in the beginning, but man, it's great. I wish I could grow a stash like that. Mine just kind of comes in blonde and red, and does not look great. But yes,
I appreciate
there you
it.
go. Make a donation at the link there.
You bet. Yeah, I just had to throw that little plug in there. I
Yeah.
appreciate it because I know Kelly definitely can't stand it. So, as
Oh,
much as I
really?
can
Oh,
get
okay.
people to say that they love it,
Yeah.
maybe I'll keep it. We'll see. I'm not
There
sure
you
yet
go.
at this
There you
point.
go.
So, all right. Derek says great stash for sure. Appreciate it, Derek. All right, Tim. I appreciate as always you joining us for our
Yeah.
IPG meeting. Thank you for all the
I,
great insights, and
thanks for
yeah, I'm
having me.
looking forward to having you back here again sometime in 2026 to share some more great insights. So.
Yeah, well, I look forward to attending, even just to listen and learn. And yeah, thanks so much for having me, as always.
I appreciate it. All right. So we are going to get right back into it so we can get you guys back with your day. So thanks so much to Tim again. We're going to go into our hot deals now. We're looking on the market today. We found two that we feel are pretty good deals out there right now. One in Chilliwack, one in Mission for detached homes. Then, of course, I know not everyone can start in a detached, so we made sure to find one that fits the criteria in the condo market so we can have other investors who are just entering in the market, see what the opportunities are out there. So we're going to kick the first one off today out in Chilliwack. This is a fairly, for the most part, newer home that was built in 2018. It is on a smaller lot, about 4,521 square feet, but the house itself is 2,900 square feet. It's a 3 up, 2 bedroom down. You've got 2 suites, beds total, 3 bath. And estimating the rent right now, we're using about $2,500 for rent upstairs and about $1,700 down. Now, again, we're trying to be as conservative as we can. We are looking on the market. We are using different programs to try to figure out where the rents are at these days. And rents were actually showing higher in a lot of different properties, at least asking right now, than what we've put up right on the screen. So the Kelly just jumped in. I'm going to pop this up on the screen. Sorry to interrupt, but she goes, bad stash. See, this is exactly what I was saying. So the more good stash we can get, maybe we'll keep it here and just drive Kelly more nuts. So, anyways, back to the property here. So this one, as I mentioned, it's built in 2018, so it's a little bit newer, less maintenance required on something like this. And as you can see here, we ran it at full list price. Now, this is the key that Tim just talked about. If you guys go out there and put some like stink bids in, those low offers, and you can negotiate and get some properties even lower, it's going to improve your cash flow quite a bit. So total gross rent's about 4,200. When you factor in property taxes, insurance, and mortgage payments, self-managing this one, you're going to make about $332 a month in cash flow. Now, one thing I did mention at the very beginning today is that you might have to put a little bit more down in the market today to make properties cash flow. But if you have the funds to do that, The opportunity right now is the fact that we have seen the property values in certain areas starting to level out. So if you can negotiate hard, get something under contract, and then sit on it, even if you put a little bit more down, you're going to do well long term. We got to go back to that long term investor thinking in order for us to be super successful. So to get into this property, you're looking at about $245,000 in, and you can hold on to this thing and cash flow $332 a month. So total ROI, because we are putting a larger percentage down in this case, we're looking at about 17.38% total when you factor cash on cash, equity pay down over 12 months, and we still factored in a 3% appreciation. Even though we know the market's been a little flat, we still factor that in. And if you get that, that's really going to improve. And of course, Lower Mainland over long periods of time tends to average around 5 to 7% when you factor in, the ups and the downs. So we know we're pretty conservative long term on that. The next one is out in Mission. It's a little bit cheaper, actually. Also a 5-bedroom, 2-bath house. It's 2 suites. Just with the age of this property and just what the going rates we found in the area, we did downgrade the rates a little bit on this one to be more conservative at $2,400 for the 3-bed up and $1,450 for the 2-bedroom down. It is on a larger lot though, so you're getting a lot more bang for your buck on this one. The reason why that one in Chilliwack is a little more expensive is due to the age. This one was built in 1981, but it has had quite a few renos done over the years. You might want to do a little bit more work yourself, but that's up to you. You can see the kitchen's been redone. You've got new flooring throughout in there. The gross rent potential is about $3,850 when you factor in property taxes, insurance, and mortgage. Cash flow is about $112,000. Again, this doesn't factor in any negotiating. Now, it will tell you about both of these properties that we've seen. They have both been on the market for quite a while, meaning when days on market go up, it is the enemy to a seller's value. So the longer the days on market go up, the more likely they're going to get a bit more motivated, and you can start shaving dollars off of those prices in order to make that cash flow go up even higher. Now, in this case, you're looking at about $238,000 invested into it, 75% mortgage LTV, as I mentioned, and we're looking at about 16.3% total ROI with that higher loan to value on this property. Now, for our final one, which is our entry-level property to be able to get into, we've got a condo out in Mission right now. This is a 2-bedroom, 2-bath, quite a large, spacious size, 963 as it was built in 1992. They're currently asking $422 on it, but I round the numbers at $400 because when you've got a investor savvy agent like myself, we're looking also into the history of it. And what we noticed is that they actually were on the market on and off for about a year at this point. They've started back in February, and at one point they were at 400,000. So we already know at one point in time they were willing to accept 400. So if we do better than 400, then you're going to be getting a great deal out there. So this one's over on 2nd Avenue in Mission, and here's how the numbers work. We factored in rent's going to be about $2,100 a month. When you've got property taxes, insurance, strata fees are actually reasonable out there at $279 a month. I mean, honestly, when I look in Poco and Coquitlam, for a condo this size of this age, you're averaging around $500,000. So they're doing something well to keep that strata fee down, which makes this a very affordable investment. And again, mortgage factored in, you're getting about $126 a month self-managed on a condo in Mission right now. And now we did again run this at 75% LTV, so keep that in mind. But you're still looking at just under $110,000 into this. And again, I think they've been on the market for so long. If they got anything under 400, like we're talking like, I don't know, maybe give them a 380 offer and see what happens. You're going to probably see that there's going to be some motivation there if they've been trying for nearly 8 or 9 months now. So those are your hot deals for the month. This one returns about 17.09% ROI annually using a 3% appreciation. And again, we were at 70% LTV. Now, factoring that conversation that we just had with the 75% LTV, we're talking about nearly close to list price. If you can negotiate hard and get a really good price on a property, rejig your numbers and see how it works with an 80% LTV. And maybe you can then increase your overall return. One, you're getting at a better deal, meaning that your mortgage payments are going to be lower. Plus, then you will offset that a little bit. Your mortgage amount will go up a bit. But when we do all the numbers, it's going to balance out. You're going to see that there's really good cash flowing deals out there when you start getting strategic with the offers that you're making. Again, we got to start thinking like investors, and we got to start thinking you make your money on the buy. No longer is it the time of we have to bid. So keep that in mind. All right, flip out your phones, point them at the screens. We have some QR codes for you guys. Of course, if you guys would like to follow the Kelly Fry team, you guys can check out all of our different social media platforms all across. We've got YouTube, we've got Instagram, Facebook, and our operations and marketing team have got me doing some silly things. But at the same time, you can also keep up to date when we've got opportunities coming up, events coming up, everything like that on our social media channels. And of course, you can also tag us at Kelly Fry Team anytime you're thinking about the Investors Performance Group. Of course, if you haven't already done so, hit that subscribe button. Help me grow this channel as well. And we'll keep coming up with great content to help you guys get better as investors. And also, one of the things that I've really been focusing on the last year is also creating more content on the podcast. That's the Manning Up on Real Estate podcast. So you can listen to it on Spotify, Apple Podcasts, like most of the major podcasting. Or you can head over, scan this QR code, and check out the actual YouTube. So we're doing video podcasting where I'm recording it, and then the audio goes on to Spotify and Apple and everything else like that afterwards. So depending where you want to see the video, you get a little bit more because we put the charts up, and depending what the topic is, you can see myself talking and showing and demonstrating the conversation of the moment. And then, of course, if you guys are on the road and you're driving, you can pop it on the radio on Spotify or Apple and listen to it in the car. And we just dropped a couple new episodes, and the biggest one was on tax assessment values. So that's this one that you can see right here. The conversation, and again, I'm not going to go too deep into this. I recommend you go and listen to it. It's only about a just over 5-minute podcast. It's a pretty quick listen, but just talking about why I expect to see tax values plummet, or at least the assessment values, I should say, plummet come December 31st. And the reason for that is because of how BC Assessment does their assessments. It's because they do their assessment back in July. So every seller right now that I go and sit down with and they say, well, my tax value is X, what I have to then try to say is, listen, that tax value is now a year and a half old at this point. And obviously in a year and a half, we have seen some serious changes. We just went through the market numbers. You guys just saw that earlier watching this video. So that's something that I think is going to happen, where we're going to see a big price shock in tax assessments come out, because we're a year and a half behind the last time they were actually updated. They were actually also updated in July this year, even though we're not getting them until December. And I think that's also going to cause some shock, where they're going to see the new drop, and yet buyers are still paying below that assessment as well. So go check that one out. Again, scan this QR code. Go subscribe to the Manning Up on Real Estate Podcast YouTube channel. Help me grow that one. We've got a goal to hit 100 subscribers before the end of the year. We are so close to hitting it. So help me grow that channel as well. There's again the QR code for donate to Movember. Again, any donation goes a long way. Even if it's only $5, it all adds up to changing the face of men's health out there. And again, the reason why I'm so passionate about this is because I lost several family members in a very short period of time to cancer. And while only one of them was my uncle, who did have prostate cancer at one point, he didn't die from prostate cancer. He did pass from bone cancer. My philosophy is that cancer research breakthroughs in one form of cancer could lead to breakthroughs in others. So help me raise money for cancer research, and let's change the face of men's mental health as well. And then also, you guys may have noticed we're no longer on meetup.com. We are making some changes right now to how we're doing things. Obviously, we're doing more live streaming, but also meetup.com was just not as efficient anymore for getting the word out there. So make sure you guys are joining our Facebook community. It's a private Facebook group. You guys can jump in there and have conversations with each other, support each other. But also, this is where we're going to post all the news when it comes to our Investors Performance Group meetings. And we're looking at some other alternatives as well to make sure we keep you guys notified when we're going live or in person as well. So we are going to talk about our 2026 plan coming soon. So make sure you guys are in the Facebook group so you know when we're going to be either live in person or online live streaming. We're going to do more combinations like this going forward in 2026. And lastly, The last one, I promise you guys, is our client Christmas party. This is the Kelly Fry Team Christmas party. And every single year, we have an absolute blast spending time with you guys. We're going to have food and drinks. Also, if you've got children, bring them along. We're going to have arts and crafts and cookie decorating. And lastly, we always have a special surprise from our friend up north in the North Pole, Santa Claus. So if you guys would like to have an opportunity to get photos with Santa, especially with your children, this is a great way that you can do it. Especially, we know the malls are getting very, very expensive. So this is our way to help you guys as our clients have those opportunities. And right now it is sponsored by Paragon Roofing. We've got other sponsors coming on board. So it's great to have all of them. And of course, they're going to be there to support you guys with your investment journey going forward. That is it for the Investors Performance Group meeting. Honestly, we are done for 2025. I hope you guys found a lot of value in all the different meetings that we did this year. And of course, in the Facebook group, I would love for you guys to drop any topics you would like to see us cover or any guest speakers you would like to have on throughout 2026. Let us know in the Facebook group throughout the next couple months. We would love to cater this to what you guys feel you need. And of course, make you guys stronger investors out there. So go join that Facebook community. You can just look it up, Investors Performance Group, or shoot me a DM and I'll send you the link. And of course, we will see as many of you guys who can make it out to the Christmas party on December 7th. Thank you guys so much again. I'm going to close it out here. I'm just going to throw this. I might just be here to attend the Christmas party. Catherine, we'd love to see you there. And again, with all that, guys, have a great night.